So let's just do a quick rundown of how that might look. So if I hit the plus button, whether we make an invoice or whether we make a sales receipt, we can record the sales tax at that time. We'll talk more about invoices later, but this is the sales side of things, just to get an idea of how the sales tax will work. Let's just call it customer number 1, generic customer 1. I'm just going to save it. And then this one, we would email it to them if we're going to email them an invoice 30 days for when it's going to be due as the invoice is sent out. I'm going to put it on 1, 2, that's fine. And then I'm going to make a new item down here for inventory item, just so we get an idea of what we're doing. So it's going to be in item number 1, generically named. It's going to be an inventory item. I'm going to copy that. And then I'm going to say quantity on hand. Let's say that there's currently 10 on hand. Now, by me doing this, it's going to record like the purchase of inventory because I don't actually have any of this inventory on hand. We're not buying the inventory like we did before. So if I tell the system there's 10 units on hand, it's going to have to record a transaction increasing our inventory by the 10 units and whatever cost we put in play. So I'm going to then say the date. Let's put it back 1 day. I'm going to say the reorder point. Let's just say it's 0. It's going to increase inventory when we buy it, decrease inventory when we sell it with an invoice. The description, I'm just going to call item 1. Sales price, let's just say is $100. It's going to record the sales to the sales of product account. Here's the sales tax. So it's going to say it's taxable. So notice it's taxable here. If it weren't taxable, I'd have to go in here and say that it's not taxable. But I'm going to say that it's taxable and allow it to do the tax. Here's the non-taxable. So we're going to say, all right, done on that. And then I'm going to say the cost, let's say is $75 an item. And the cost is going to go to cost of goods sold. So let's go ahead and save that. And so now we have our item here. And let's say that we're selling. Whoop, did it not record it? Let's say that we're selling 2 of them. So that's going to be $200. Sales tax is now being checked off because the item told us to check it off. We could uncheck it manually, but you would like that to populate automatically. There's the 200, and here's the sales tax. Here's the point of this. So we'll talk more about invoices later, but they're somewhat complex. All that is being done with an invoice. What's this doing? It's increasing accounts receivable by $216 when I record it. It's increasing revenue by $200 though. What's the difference? $16. It's also going to deal with the cost, the inventory going down by the cost, which I said was $75 per unit. And then it's going to record the cost of goods sold and reduction of inventory. And it's going to deal with the subledger, recording the subledger for the customer, which will track the information by customer, and the subledger for inventory because we're using a perpetual inventory system. But our major concern here for the sales tax is this idea of we're going to actually collect from the customer $216, but we have $16 that's sales tax. Now, there's 2 ways that you can think of doing this, and this is important to note because this will come up when you do taxes if you're in the United States, and that is method number 1. Why don't I just record revenue at $216 and then record a sales tax expense of $16 because I'm basically the one doing the work, charging the $216, and then I have an expense of $16 that I have to pay to the government. And then when I pay it to the government, I should have the $16 expense. That would make sense. But the government is saying, well, no, this isn't your expense. They're trying to act like it's the expense to the person buying it and you're just the tax collector, right? So that means it shouldn't hit the income statement. So this $16 isn't going to be recorded as revenue, only $200 as revenue. The $16 is going to go into sales tax payable, a liability account, and then we pay it out of the liability. So that's important because at the end of the year for income taxes, people will often ask, hey, look, I paid all this money for sales tax. Where's my sales tax expense, which should be reducing my income so that I had pay less taxes for income taxes? And it's like, well, no, there is no sales tax expense. It's not that you didn't pay sales tax expense. It's that you didn't record that in revenue, or you should not have. It should have been reported on the accounts payable if you did it properly using the whole widget system and the invoice, right? So let's see what this looks like. If I go ahead and save and close this, and then I go into my balance sheet and run it, and then I go down to my liabilities, I have, well, let's just look at the whole thing. In accounts receivable, what happens? Accounts receivable is going to go up. So if I go into the AR, there's my accounts receivable. It's for the full amount of the 216. If I drill down on that, that gives me my invoice for the full amount, 216. Closing that out, going back to my form. The other side's going to go on the income statement. That's on this sheet. Let's run it to refresh it. And we're going to have revenue of the 200. Only 200, not 216. I go into that amount. There's the data, the 200. If I go into it, where does that come from? That's the amount that we charged, not including the sales tax, the extra $16. Where does the $16 go? Let's close that out. Go back to our income statement and then back to the balance sheet. It's going to be a liability. It's on the balance sheet, not on the income statement, as a liability for, I think, where it shows it by who we have to pay by vendor, which is a little funny, but let's go into this one. So there it is. There's the $16 that we have to pay. So that increased the liability, and then also inventory was impacted because we had inventory is going to be reduced because we sold inventory, and then the cost of goods sold over here is here. So the difference between 200 and 150 is the net increase in net income. But we're concerned with this sales tax. So now we've got this sales tax that increased down here. It puts it into an account based on who we're going to pay. This is basically the vendor, in essence, or the government agency that we have to pay in California, the Board of Equalization payable. And so if you don't like the fact that it has this account, you might make a parent account called sales tax payable and then put these as sub-accounts under it so that you can collapse it into one account if you want to, so it doesn't look like this vendor name out there. But in any case, so that means you're going to have to collect the sales tax. And then the question is, well, when do you have to pay it? So you're going to have to collect it, and then maybe you pay it, like if you collect it in January, maybe you pay it in February, or maybe you have to pay it after each quarter. You have the first 3 months, and then you have to pay it for the first month in the second quarter, first quarter sales tax. It depends on the location, but that's how it's going to work. You're going to collect sales tax, and then once you have the money, you're going to have to pay it based on whatever the terms are in the location that you're in, which is where we see it as a payable in essence, because now we have sales tax payable in essence, which is similar to accounts payable that we have to pay to basically the government for the sales tax that we have collected. So how are we going to pay that amount? Well, we could just write, in essence, a check form or an expense type form. So if I hit the plus button, it's going to be a check or an expense. Those are the forms that decrease the checking account. However, it's similar to what we saw with the bills form. Remember, the bills form is like a check or expense form, but it specifically decreases the bill. So if I use the little widget system in order to record this, I should get a special payment check that's going to be for sales tax. So it's going to be, a sales tax payment check. And I would do that by hitting the plus button down here and making the payment through the special little widget down here for the taxes. Where did there it is. And then we're gonna make the payment. Now I don't want to, I have to set up the whole thing, but typically there would be a payment down here that would help us to determine the amount that we have to pay. Now, it's not that difficult to figure out how much you have to pay for sales tax. Typically, if you have the sales tax collection system set up properly, because all you have to do is kind of look at the sales tax for the prior period and figure it out. So the widget isn't doing like as much detail to help you as with the payroll kind of system, but it's still kind of useful to do. The general idea would be that it would be making a payment, which would be again a check or an expense form, which would decrease the checking account. Let's go back. I can go back. I'm on the wrong. Dang it. Let's go back into the reports. And then let's go into balance sheet, putting this back in place, 01/01/24 to 12/31/25. And then I'm going to select the drop down years and run it. So that would decrease, in essence, the checking account, and it would decrease then the board of equalization, which if I'm using the widget, it's hard to kind of do an example of, because the widget kind of works in real time at when the thing becomes due, and the practice session here doesn't always have the widget working properly because they're trying to do something that's going to be there all the time. But the general idea is you'd go in there and say, okay, now I'm going to pay the sales tax, and it would make, in essence, a special check form, which would decrease this account and decrease the checking account with a special name to it.